By the way, here's the secret to spring break. It's all fun and games until someone loses an eye or gets pregnant. It's all fun and games until someone loses an eye or gets pregnant. Have those both happened on spring break before? Absolutely. Okay, now let's get back to bonds. Uh, we have a special name for the green and blue bond ratings up here. What was it? Investment grade. And what did we call the lower ones? What's the slang term? Junk. And what is the marketing term? High yield. Thank you. Okay, so that's what we're talking about here. Now, just like with grades at MSU, other than in my class, there are pluses and minuses here. So, except for AAA, which does not have an AAA plus, it's just AAA, but you could also have an AAA minus. And you can have an AA plus, an AA, and an AA minus. And so the lowest lowest investor grade bonds would be BB, would be BB, or no, BB, sorry, would be BBB minus, or BAA minus would be your lowest investor grade bonds, which means your highest junk is going to be BA plus or BB plus. So there's the dividing line. Okay, let's talk about some different types of bonds. Yes? So the ratings people have their models, and of course, there's probably a lot of subjective things that go into this. First of all, you're having to figure out what does the future of the company's industry look like, and then what does the future of the company look like versus its competitors. So yeah, there's a lot of stuff to it. It's kind of like equity analysts. You'll see there will be some that'll say buy, others say hold, and others say sell. So they're all coming up with these different things. Now, the big point though is, do you think that bond ratings tend to be higher than they should be or lower than they should be? Remember who's paying for the ratings. They're going to be higher than they should be. Yeah, and people get upset if you downgrade their bonds. For instance, S&P downgraded United States Treasury bonds from AAA to AAA minus. Moody's did not. Remember, both of these clowns were involved in that problem I talked about last time where they were giving AAA ratings to bad crap. Which one of those do you think was the only one that got investigated by the United States government? It was S&P, because they were the ones that had downgraded U.S. bonds. Moody's got off scot-free. Yeah, there's a lot of, and we'll see that we call them split bond ratings. When S&P and Moody's disagree on someone, that's a sign that there's what we call information asymmetry, meaning that the information isn't available to everyone and not everyone sees exactly the same thing. Just because they agree doesn't mean they're right, but when they disagree, you know one of them's wrong. Does that help you out? Yeah. So in the end, we're just talking about people making a call, and people are subject to all sorts of forces other than pure rationality. Okay, in the United States, our central government is called the federal government. And the federal government borrows money in several different ways. We've talked about treasury bills. Treasury bills have no coupons whatsoever, which makes them a pure discount instrument. In other words, I'm going to pay $970 for it today with expecting to pick up $1,000 at the end of 3 months. So that's how that works. And then we have treasury notes. Treasury notes have semi-annual coupons. Treasury bonds also have semi-annual coupons. What do you think the difference between treasury notes and treasury bonds are? Say again? Okay, so you're getting close. It's the amount of time, right? And so the bonds are going to be original issue maturity, anything greater than 10 up to 30, right? And the notes are going to be anything greater than 1 up to 10. Okay, now here's the fun thing. All federal bonds that you buy, those coupons to you are going to be free of, oh, for shame, she's late. They are going to be free from state tax, but they're not free from federal tax. So the federal government says to the states, hey, you guys can't tax this, but we can. Now, why can the federal government get by with that? Because of the primacy of the federal government over the state governments, they can get by with that. Okay. So now let's talk about, that's the central government. Now, everything else in the US, when they issue debt, we call them municipal bonds. So if it's your state, your county, your school district, your sewer district, the road district, when they issue debt, in fact, city utilities, because it's owned by the city, when they issue debt, those are also called municipal bonds. Now, municipal bonds are kind of interesting because they are free of federal tax. They're free of federal tax. Now, the question is, why does the government say we're not going to tax the interest on these municipal bonds? It's because of what municipal bonds are used to do. They're used to build infrastructure. In theory, they're used to do things that are going to strengthen and grow the economy, leading to more tax revenue for the federal government down the road. And so the federal government's trying to increase that kind of investment, and so they're going to give you a cut on the tax rate, on the tax. Now remember, we said that people are interested in after-tax return, and so with the municipal bonds, your federal before tax and your federal after-tax return are exactly the same. So what does that mean for investors? They don't require as much return. And as a result, it means that the municipalities can borrow for cheaper. And so this encourages, so more projects become basically positive NPV projects for the communities. Let's give you an example here. Back in the mid-1990s, you've got most of the people in China living on the coast. You've got most of the fruits and vegetables being grown inland. And the roads were so bad that the fruits and vegetables would get rotten before they reached the coast. Bad for the farmers because no one wants to buy rotten fruits and vegetables. Bad for the people on the coast because they really couldn't get fresh food. And so then the government paves these highways coming in from the farm areas going to the coast. And what do you think that did to the economy? Yeah, juiced it. So, and you should see, for projects like that, you should see this huge return on the investment. Now, the first highway gets you a lot of return. How much does the second highway get you? A little less. And so that's what we've seen with China and their economy. In the beginning, the money they were investing were getting them great leaps and bounds. The stuff they invest now is getting them hardly return at all. In fact, some of it's negative. Okay, so that's municipal bonds. Now, here's the fun thing about municipal bonds and their required return. I sub m is the interest required on a municipal bond. I sub t is equal to the interest required on an otherwise identical taxable bond. What do we mean by otherwise identical? It's got the same time to maturity. It's got the same risk. It's every other way exactly like the municipal bond, except for the fact that the returns are taxable. And then we have T, big T, which is the marginal tax rate of the investor. What is a marginal tax rate? Yeah, the tax that we're going to pay on the very next dollar, right? Okay, so that's the marginal tax rate. And why is it the marginal tax rate here? Because that's the tax rate that we use to make decisions as investors, is that marginal tax rate. Because this income is going to be on top of the income I already have. So that tax rate that I use to decide these things is going to be my marginal tax rate, not my average tax rate. Okay, now knowing this, and one other thing about the United States taxation system, the more income you make, the higher your marginal tax rate. The more income you make, the higher your marginal tax rate. So, who's going to be interested in these things? Yeah, people with high incomes are going to have high marginal tax rates. And let's talk about it here. What if I had a bond that was a municipal bond that was offering 7%, and an otherwise identical one was offering 10%? That means that that marginal tax rate where people would be indifferent would be 30%. 1 minus 0.3 is 7. 7 times 10 is, or 0.7 times 10 is 7, right? Okay, so what does that mean? It means that if my marginal tax rate is 28%, I'd be better off investing in the taxable bond. But if my marginal tax rate is above 30%, then I would be better off investing in the municipal bond. Folks, this is not hard math to do. In fact, if you look at, if you use TurboTax and you look at your last, it gives you a report and it'll tell you what your marginal tax rate was. And so you can start to do the math on these things. When my wife and I first got to Springfield, we had, this is back when people had landlines. I had a landline, it rang, I picked it up, and the guy said, "Mr. Haggard?" I said, "Yes." He said, "This is so-and-so from Edward Jones." I said, "What can I do for you today?" He says, "It's what I can do for you." He says, "I want to talk to you about municipal bonds." I covered the mouthpiece of the phone. I turned to my wife and I said, "Honey, we've made it. Edward Jones thinks we have enough money to give a damn about municipal bonds." I uncover the mouthpiece and say, "Thank you," and hang up. Okay. Now, my brother-in-law, great guy, he drives a truck. And I don't know if you know about the United States tax system, but the more kids you have, the more tax deductions you have. My brother-in-law, because he's very fertile, he has a 0 marginal tax rate. Would he have any interest in municipal bonds at all? No, no, none. How about other investors that don't pay taxes, like pension funds don't pay taxes? Should pension funds be holding municipal bonds? No. Okay, let's talk about 0 coupon bonds. We've mentioned them a little bit, but we need to know that all the principal and interest gets paid back at maturity. All the principal and interest gets paid back at maturity. And we use the word interest here. It's a little confusing because the coupons are truly the interest payments. We should say all the principal and return comes at the end. It's always got to be a discount bond if expected returns are positive. Only if expected returns are positive. Now, we didn't used to have to say this because interest rates were never negative. But then we started having these central banks that try to manipulate the interest rates to juice economic growth and things like that. And so what we ended up with, especially in COVID, we had, and the financial crisis, I believe, we had interest rates in certain countries dip below 0. They dipped below 0 in Japan. They dipped below 0 in Germany. And as a result, their 0 coupon bonds actually sold for a premium. Why? People were buying those up to park their money in a safe place because the world was falling apart. Does that make sense? Most of the time, though, we have positive expected rates of return, and so these things will always be discount bonds in those situations. They've got a couple of other names. We call them zeros and deep discount bonds. Deep discount because they have no coupons whatsoever. That's why that capital gain has to be so big on them. Then we have floating rate bonds. Remember when we started this off, I told you that the coupon rate was the same throughout the life of the bond, except for floating rate bonds. And here's what's going to happen with floating rate bonds. They are going to reference a benchmark interest rate, probably the 10-year Treasury, and then they're going to have an adder on top of that because of the default risk of the bond. And so it'll be about 2 or 3%, something like that. And whenever they're going to pay a coupon, they're going to reference the Treasury yield for 10-year on that day at 3%, and that's what the coupon's going to be. Now, the reason that we do this is that if those coupons float, and they float exactly with the yield to maturity, what does that mean about the value of the bond? You don't know? Yaro's trying not to look at me. Yaro, what does it mean if the yield and the coupon rate float exactly together? What's the value of the bond going to be? Say again? Oh, there you go. Okay, here we go. Whoop. Oh, I'm sorry. Would you hand that to her, please? I should learn to start throwing harder up, but I don't want to chip your teeth or anything. Okay, so what does this do? It transfers the interest rate risk away from the lender and puts it on the borrower. If we are putting more risk on the borrower, then that means the yield to maturity is going to be lower because the lenders are facing less risk. It's like the adjustable rate mortgages. Adjustable rate mortgages put the interest rate risk on the borrower, not the lender. As a result, adjustable rate mortgages rates are usually lower than the conventional rates because you're taking on more risk. Now, if you get a 3-year adjustable rate mortgage and you know you're not going to be in a house any more than 3 years, is it a big deal? No. And so my wife and I, when we were in Ohio, we figured out 6 weeks in that we didn't want to live there. So when they finally finished our house, we did an adjustable rate mortgage and we sold the house before things started to adjust on us. Income, go ahead.
For the issuers,
Uh-huh.
budget the
Oh yeah, so you have to have some sort of prediction for what's going to happen with interest rates. Yeah, it throws some uncertainty in. And remember, uncertainty is risk. And we just said they're taking on risk from the um, borrowers. I mean, from the lenders, sorry. Other questions? Okay, now let's talk about income bonds. Income bonds only pay their coupon when the net income of the firm exceeds a certain amount. Let's say it's $100 million. If the net income exceeds $100 million, then we'll pay the coupons. Here's what you need to know about net income reported by companies. There's a huge amount of managerial discretion in how much income gets reported. If at 100 million, we are going to have to pay coupons. If we're anywhere close to that, here's what managers are going to do. They're going to accrue expenses from the coming period into the current period. They're going to drive down that net income down to where it's just 99 million. Sorry for your luck, bondholders, right? Don't ever buy income bonds. In fact, one of my colleagues in finance says they have the smell of death about them. There's a certain amount of desperation that goes with issuing these things. It's just like a friend who says, hey man, can I borrow $100? And you say, sure, when will you pay me back? And your friend says, when I get a job. Who totally controls when he gets a job? Your friend, right? And in fact, now they have an incentive not to get a job. Does that make sense? So stay away from income bonds. Now let's talk about convertible bonds. Remember, bonds are debt, and here's the problem with debt. There is no upside to debt. There is no upside to debt. When I pay my money for that bond, I know what those coupons are going to be, and I know what that last thing's going to be, and that's it. If the company does great, that's what I get. If the company does okay, that's what I get. If the company barely gets by, that's what I'm going to get. There's no upside to bonds. There's only potential downside if they default, right? Now, we could sweeten the deal for bondholders by saying, hey, wait a minute, you could take these bonds and convert them into a certain number of shares of stock. Now, let's talk about when this would happen. So let's say that the stock is currently at $20 a share. And I will tell my bondholders that they can convert each $1,000 face value bond into 40 shares of stock whenever they like. Now, right now, that bond costs $1,000 divided by 40. That is $25 a share. It's not worthwhile for the bondholders to convert into stock until that stock price crosses $25. And now the stock is worth more than the face value of the bond. Maybe it's worthwhile. But I would tell you not to convert at this minute because there's a chance that the stock price will do what? Yeah, it may go back down below 25. So what do? You'll wait until you're ready to cash out of this investment, and then you can, if it's profitable, you convert the bond to stock, and then you sell the stock. Does that make sense? That way you can capture that extra value. Are people willing to pay for lottery tickets? Yeah. If you don't believe me, go hang out in an American convenience store and watch the people lining up to buy lottery tickets, cigarettes, and liquor. Those are the three big things at convenience stores. Oh, by the way, they've got those gambling machines too, so they're indulging almost all the vices except for prostitution. Back to the story. People are willing to pay for lottery tickets. Now, this conversion thing on the bond is a lottery ticket. Why? Because if the stock just goes to the moon, woohoo, right? We've got value out there. So the chance of having this big win out at the end makes bondholders willing to demand less yield to maturity to hold these bonds. And so this is good for the issuer. It lowers their cost of borrowing. Now remember that our goal of financial management is to maximize what? Shareholder wealth, and it's the wealth of the current shareholders. And so as a manager, when would I issue convertible bonds? When the investing public thinks the stock's about to take off, but I know it's not, right? I know it's not. As a result, I can borrow more cheaply, and I'm pretty darn sure those bonds aren't going to get converted and dilute my current shareholders. So that would be the signal to me. If someone says, oh, hey, we're going to issue convertible bonds, I'd say, I wonder. I need to do a study on that one. Okay, so that's convertible bonds. Now, the big question students always ask is, could I convert back? No, it's a one-way trip. It's a one-way trip. You convert, and then you're stuck with that stock, and then if the stock goes to zero, you're in a world of hurt. So it's kind of like being able to own stock, but to have a floor to your losses, right? Because if the stock goes straight to hell, at least you've still got the bonds, right? And as long as they don't go bankrupt, you still get to collect your coupons. Questions? Okay, then we've got put bonds. Put bonds are bonds that the issuer can, or no, sorry. So do you guys remember the call provision, which allows the issuer to force you to sell back? They force you to sell back at a premium. So they're going to give you a little something extra for the ability to sell you back. Now, a put is the other way around. A put bond is one that I can force the borrower to buy back at a discount. It's a bond I can force the borrower to buy back at a discount to par value. So let's say that discount is $100. That means if the bond price gets down to 900, I can force them to buy that bond back. In theory, this puts a floor to your losses on the bond. You'll never lose more than $100, right? Because it puts that floor there. Now, here's the big question. What happened to make that bond worth less? The yield to maturity must have gone up. Two reasons for that to happen. Number one, interest rates have gone up. Or number two, the firm has become riskier. In the first situation, now if they go out to borrow more money to buy your bond back for 900, they're having to pay a higher interest rate for it. In the second situation, if the yield of maturity is up because the firm's risk has gone up, there's a chance that no one's going to loan them that money. So this $900 they're going to pay you is not really a guarantee because they could just declare bankruptcy, right? And then legitimately. Okay, so those are put bonds. Know the difference between put bonds and callable bonds for the exam. Know the difference between put bonds and callable bonds for the exam. So now we're going to talk about how bonds are sold. If you've seen these things on TV where you see people standing in pits and waving their hands, that is not a bond market. Bond markets all happen OTC, or over the counter. Now, the original meaning of over the counter was literally that. The bond broker, the bond dealer, would have this inventory of bonds, and you would go in and buy the bonds, and they'd hand it to you over the counter, and you'd hand them your money over the counter. Yaro, you got a question?
You just like know the difference between put bonds and convertible bonds?
Callable bonds. Callable. So, no, you have to go back a few slides. If you were paying attention last time, you'd know what a callable bond is. Okay, back to the story. So where do the dealers get these bonds? Well, they purchase them directly from the issuers. In fact, I think it's every Thursday the United States government auctions off Treasury bills, notes, and bonds. And you go out, so people go out there and bid on those. And then those people that buy them are the bond dealers, they turn around and sell them. Now, how does a bond dealer make money? You might say, whoa, they're hoping that the value of the bonds that they're holding in their inventory go up. No. The reason is that if they've got interest rate risk and the value can go up with interest rates, what's true also? It could go down. And so most of the time what you see is these bond dealers are actually hedged against changes in interest rate. The only thing they're interested in making their money from is the difference between the ask price, which is what you're going to pay if you go to buy one, and the bid price, which is what they're going to pay you if you sell one to them. Now that ask price always has to be higher than the bid price because that's where their income comes from. That's where their income comes from. We call that difference the bid-ask spread. It actually should be ask-bid spread because it's ask minus bid. But for some reason we say it backwards. Why? I have no idea. If you're involved in this business, by the way, if you are holding an inventory and you stand ready to buy or sell, you are a dealer. That's different than a broker. A broker never actually holds an inventory. They never take possession. The dealer actually takes possession. So they're sitting there holding this inventory, standing ready to buy or sell. And because they're always ready to buy or sell, we say they are making a market in this particular security. So if I have an inventory of this certain General Electric bond, and so I've got my bid and my ask out there, I am making a market. You can always buy or sell at those posted prices. And that is how the bond market works. It's not one central place where people are buying and selling. It's all these different dealers that have their different bids and asks out there. By the way, do you think their bids and asks are very close to each other? Yeah, they have to be, or they wouldn't be able to buy bonds or sell bonds. So they've got to keep with the market, right? Okay, let's take a look at bond quotes. Bond quotes are kind of freaky. Bonds are quoted in percentage of face value. Let me say that again. Bonds are quoted in percentage of face value. Bonds are quoted in percentage of face value. So what we have here is a bunch of different bonds from a bunch of different maturities. And the first column is maturity. That's the date on which that face value is going to get paid. And then next over is the coupon. Now the coupon is also in percent of face value. The coupon is also in percent of face value. And so you can see that we've got all the way from 1/4% all the way up to 7.625 on this one. Now, by the way, these are all United States Treasury bonds. And so basically what you're seeing here is an artifact of the changes in interest rates, likely due to changes in inflation. So when inflation goes up, what does the Federal Reserve do? They raise interest rates. And when they raise interest rates, investors are demanding more return. As a result, the Treasury Department, when they issue these new bonds, they are going to put coupons on those to try to match the expected yield to maturity. And if those coupons exactly match the expected yield to maturity, what does the bond sell for? Yeah, it sells at par, right? It sells at face value. So that's the idea here. So what you're really seeing here is like an archaeology of interest rates. So that's the first column, or the second column is coupon. Then we have our bid and our ask. And I want you to notice that the bid is always at less than the ask. It has to be. The next thing I want you to notice is how small the bid-ask spread is. It's pretty small, and that's because these people all compete against each other. What does that mean for how these people make money? They have to sell lots and lots of bonds. They have to sell a huge volume of bonds in order to be able to make money on this deal. And by golly, the United States government is more than willing to borrow a boatload of money to make a big enough volume for these dealers to do their business. Now we have so we got bid, ask, and by the way, those are percentages of face value. Can you see some discount bonds up there? By the way, par bond would sell for how much percent of face value? 100. So we've got two, three that I can see, 3 discount bonds. And we have a lot of premium bonds. What does that mean has happened since those bonds were issued? Interest rates have gone down, right? They've gone down since those bonds were issued. Now look at this change. That change is the change in the asked price. If the ask price has gone down since the last trading period, what does that mean has happened to interest rates since the last trading period? Yeah, they've gone up, right? Because those things always move in opposite directions. And then finally, we have the asked yield, which is the yield to maturity calculated using the asked price. Why calculated using the ask price? Because if you go to buy one of these for your own portfolio, that's what you're going to pay. And if we had the maturity, or if we had the actual date of these quotes, we could do that calculation for ourselves and see that it comes out and matches up. Now, remember we said current yield was the annual coupon divided by the bond price. You guys remember that? So that annual coupon was the coupon rate times the face value. And this bond price is going to be the quoted price, which is in percentage of face value, times face value. This gives you the price of the bond. This gives you the annual coupon. What happens to those face values? They cancel out. So if I give you the information on a quote to find the current yield, all you have to do is take the number from coupon and divide it by the number from asked. You don't have to multiply them both by face value. That's a waste of your time and you'll probably mess it up anyway. So don't do that. Just take the value from the coupon column and divide it by the number in the asked column. Questions? It's the yield to maturity based on the ask price on the date of this quote. And if we actually had the date of this quote, we could actually calculate that in the same way that we've calculated yield to maturity earlier in the chapter. They should say asked YTM or YTM sub ask. So it's the yield to maturity based on the ask price. And why based on the ask price? Because that's what you're going to pay. If you go out to buy this, you're going to pay the ask price. Good question. Other questions? Okay, now let's talk about inflation and interest rates. So there are two kinds of returns that you're going to hear about in finance. You're going to hear about nominal returns and you're going to hear about real returns. Nominal returns have to do with how much currency you receive back. If I invest $100 and I get 110 back after 1 year, the nominal interest rate is 10%. And you say, wow, that sounds pretty good. But what if I told you that inflation was actually 12% during that time period? It means you can afford less stuff with that 110 in 1 year than you can with 100 today. Is that what we want? No. And so there has to be this relationship between return and expected return and expected inflation. Let's get to the heart of what we're really interested in when we invest. We're interested in increasing our ability to consume. If I cannot increase my ability to consume as a result of having made this investment, I shouldn't do it at all. So what we're looking for here is a positive real return. A real return describes the increase in your ability to consume. Let's put it in really simple terms. Today, I have enough money to buy 10 pizzas. But instead of buying 10 pizzas, I'm going to invest that money. In 1 year, I have enough money for 12 pizzas. How much was my real return in terms of pizza? 20%. It's 12 minus 10 divided by 10. I've got a 20% real return. I have improved my ability to consume by 20% by making that investment. Now, did you notice we didn't talk anything about dollars or euros or anything like that? So real return purely has to do with your ability to your increasing your ability to consume. And it turns out that these two things are related by inflation and the Fisher effect. By the way, big R is the nominal rate. Big R is the nominal rate. And inside big R, we have both real return and inflation that are kind of fighting together. And that's what you're going to actually see when you go down to the bank. Those are always nominal rates. Or when you look at your stock returns, those are always nominal rates because they're all based on the numbers of units of currency. Little r is the real rate of return, the increase in your ability to consume as a result of having made the investment. And then we have H. What in the world is H? Inflation. Now you might say, wait a minute, why don't we use I for inflation? Yeah, I could also be interest, just confuses the fire out of people. Hey, you want to make it even worse? My colleague, Dr. Whitty, he's better trained than I am. He went to schools where they actually still use Greek letters and stuff like that. So he'll always use pi for inflation, and that's common. Why don't I use pi for inflation? Yeah, because some dumbass will say h equal 3 or pi equal 3.141, right? Do they ever get the problem correct? Unless inflation is 31,000% or whatever. Yeah, no, they're not going to. Okay, now if I leave my equation, if I put this equation on my note sheet like this, I can solve for any one of those things really easily. So for instance, let's say I'm going to solve for h. All I have to do is divide both sides by 1 plus little r, and I get 1 plus h. You see what I did? I just divided both sides by 1 plus little r. It cancels out over on the right. I'm left with 1 plus h. Now I'm only one step away from getting the h out of there. What do I need to do? Yeah, all I need to do is subtract 1. So I can say h is equal to 1 plus r divided by 1 plus little r minus 1. So that's the reason I write this equation that way, because it makes it really easy to move things around. Now, I want you to notice that down at the bottom is this approximation. And I am warning you not to touch that thing. It's a hot stove. This approximation is only suitable for when you're out drinking with friends and you're talking about interest rates and inflation and you're just having fun, like you kids all do, right? Perfectly fine then to use that approximation. Here's the reason that's not actual. So what if I actually work this out? 1 plus r times 1 plus h. I sure hope you guys remember a little bit of algebra. So first, outer, inner, last. Do you remember that? Okay, so here's 1 plus outer, h plus inner, r plus last. So this is 1 plus big R is equal to that. What happens to the ones? Yeah, they go away, right? And so what's left over here for big R is H plus little r plus RH. That's the problem with the approximation. It ignores the plus RH. The bigger R is, the bigger H is, the bigger your error will be between the exact and the approximate. Should you ever use the approximation on my exams? No. Should you ever use the approximation on my homework? No. Should you ever use the approximation on the practice? No. When is it okay to use the approximation? When there's nothing really at stake. At the bar, after work, with your bros, right? Perfectly fine then. Questions? Let's talk about the term structure of interest rates. So what we've got here is we've got interest rates on the vertical axis, and on the horizontal axis, we've got time to maturity. And the way we build this term structure of interest rates, first of all, we're using United States Treasury stuff. And so there is zero default risk. So everything that you see here is default risk-free. The second thing that we're doing is that we are breaking this down, and you can basically, it's called separate trading of registered interest and principal. I can go out there and buy a single coupon for a year and a half from today. I can go out and buy a single coupon for 7 years from today. And those things all are out there and are priced, and there's the yields available. And so we can build this entire term structure of interest rates by looking at the required yields for those different zero coupon times, right? I don't expect you guys to remember separate trading of registered interest and principal. By the way, they're called strips. Why? Because it's separate trading of registered interest and principal. It just came out that way. Okay, so this doesn't have any sort of intermediary coupon situation with it. It doesn't have any default risk. So this is just purely the term structure of interest rates. And what we see is 95% of the time it is upward sloping, which means that this stuff that's really short has a low yield, and the stuff that's going to be out there for quite some time has a higher yield. In fact, this is how banks make money. Banks borrow money on the short term, savings accounts, CDs, checking accounts. They pay very little in interest on that stuff, but they turn around and they collect higher stuff at longer terms on things like car loans and mortgages, things like that. So this is the money machine for banks. It's all fun and games until something happens that makes the term structure do this thing. If it starts to be downward sloping, what does that mean? It means that banks are having to borrow at higher rates than they can lend at. Is that a good recipe? No. Would you want to buy apples for a quarter and sell them for a dime? Absolutely not. And so every time we see this, if this persists for any length of time, what we see are bank failures. And I've seen it at least twice in my lifetime where this happened and then banks start to fail. Now, what's making this thing look the way it does? Well, we think of this as being 3 layers of a 3-layer cake. And that base layer is the real rate. And we have no theoretical reason to believe that real rates should change with the amount of time to maturity. We don't have any theoretical basis for that. If you come up with one, please let me know. We do know that what's on top of that is the inflation premium. And so this is the expected value for inflation out at these different points. So the higher the inflation, the steeper that inflation, or if inflation is increasing, that's going to look like this. If inflation is decreasing, it will look like this. And then the very last thing is the interest rate risk premium. And remember, we said that interest rate risk increases with the time to maturity, but it increases at a decreasing rate. And so if you had real rate being flat and you had the inflation premium being flat, this thing would still be upward sloping at a decreasing rate. Now, how does it end up looking like the second picture? Inflation goes up, the Federal Reserve steps in to push up short-term interest rates. By the way, inflation is too much money chasing too few goods. And so what happens when we've got all this money on the street? How do we get it off? Well, we push up short-term interest rates to pull that money in off the street. Perfect example. I was talking to my grandfather in the late 1970s. And I said, "Grandfather, your car is a 1966 model." And he said, "Yes." I said, "It's a piece of junk." He said, "Yes." I said, "Why don't you buy a new car? I know you can afford it." He says, "Because I've got my money down at the bank making 17%. Were they effective in getting my grandfather to pull his money in off the street? Absolutely. It's parked in the bank at high interest rates. Now, here's the trick. Whenever you pull that sort of operation, what does the market start to expect about inflation? Is it going to be going up or down? Yeah, it's going to be going down. So notice how the inflation premium here for the short term is high, but it's going down over time. So we have expected inflation going down over time. And so that's where this downward slope comes in, from the fact that we've pushed up the short-term rates, and then this inflation premium is now downward sloping. And if it is downward sloping enough, it can overcome that upward sloping nature of the interest rate risk. And now the whole darn thing is downward sloping. And that's when you want to make sure your money is in an FDIC insured account, because some banks are going to start to fail. Questions?
Like, is it houses or is it cars?
Oh, so the short-term interest would be like if you're going out to, or if you're going to put money in a CD, or if you're going to put money in your savings account. That's on the bank's end. That's what the short term is going to look like. What we're really looking at here are treasury bills that are going to basically mature tomorrow. That tells you what's your shortest term. Good question. Other questions? Okay. So what are the determinants of bond yields? Well, we just got through talking about the term structure. So that's the first three things. And then there is the default risk premium. Remember, I told you that term structure is default risk free. And so if we've got default risk, that's going to add up on top of it. And then we have the taxability premium. The taxability premium is the opposite way of thinking about it. We usually think of municipal bonds having, basically, there's a discount in the required return. We could also think about taxable bonds having a premium required because of their taxability. In fact, the opposite of that I sub M, that I sub T, we have another name for it. It is taxable equivalent yield. Or TEY. And so if I take that I sub t minus I sub m, that's my taxability premium. And then finally, we have what your book refers to as the liquidity premium, but it's actually an illiquidity premium. So if something's liquid, it means you could sell it at or near its full market value in a very short amount of time. And if I'm going to be investing in something, if you're going to tell me that I can't sell it at full market value in a very short amount of time, perhaps I have to hold it to maturity, then that is illiquid. And I'm going to require additional return to hold such an asset. Let me explain with a real world example. A young man has $25,000. He has no plans to spend any of that money for the next 5 years. And so he goes down to his broker and tells him his story. He says, I need this money 5 years from now, but I don't need it today. What can I do? And the broker says, you should probably invest in bonds. And the young man says, okay, tell me about bonds. He says, well, I've got these two bonds here. They're otherwise identical, except for this one is issued by a public corporation and is publicly traded. You can sell it any day you like and get your money, or you can put it over here in this one and you'll have to hold on to this one for 5 years to collect the face value. And the young man says, well, what's the difference in the yield? And the broker says, well, because this one's illiquid, it has to pay a higher yield to maturity. Therefore, this one has a greater return. So what do you think the young man does? Yeah, he takes the one with the greater return. Okay, that night, the young man gets home where his girlfriend is waiting for him. And she says, I've been thinking. Guys, those are the 3 most terrifying words a man can hear. I've been thinking, especially if it's preceded by honey, because there's honey. Oh, okay. I've been thinking. You're either going to have to spend money, do work, or both. That's what's going on. Just so you know. Okay. And I see I've got some females agreeing with this is how it works. Okay. So she says, I've been thinking, and he says, what have you been thinking? She says, I've been thinking we should get married. He says, wow, I've been thinking the same thing too. As she says, I've been thinking I should get an engagement ring. By the way, for those of you who are not from the US, the engagement ring is the way the young man marks his territory to keep other potential men from trying to steal his woman, right? And by the way, how does the size of the diamond work with the repellent value? The bigger the diamond, the fewer the competitors, right? It's like the Serengeti. Okay, back to the story. So he says, where are we going to get this diamond, this ring? And she says, Cartier. You guys know what Cartier is? Yeah. How much money are we talking? He says. Oh, only, by the way, guys, get used to that one too. Only $25,000. He says, I've got great news. She says, what's the great news? He says, I've got $25,000. And she says, yay. And he says, but I also have some bad news. She says, what's the bad news? And he says, you're going to have to wait 5 years to get your ring. How do you think the story ends? I'm going to put it in hopeful terms. The young man gets a new girlfriend. Right? What's the reality? She dumped his ass. That's the danger of holding these illiquid assets. If he had earlier in the day bought the liquid bonds, he could have easily gotten out of the position. He could have easily bought the ring, and he'd probably still be with her, for better or for worse. Okay, so here's the problem. Finding the buyer. If nobody's making a market in these bonds, then they are truly illiquid, and you basically just have to wait. Or you could tell your bond dealer, you're like, hey, if you find some other dumbass with $25,000 who doesn't have a girlfriend, feel free to give me a call. I'll make you a good deal. Does that make sense? Yeah. Now remember, illiquid doesn't mean you can't sell it. It just means you can't sell it at or near full market value in a short amount of time. So I'm going to either have to take a tremendous discount to sell it immediately, or I'm going to have to wait a really long time in order to be able to sell it for full market value. Either way, the young man is out of luck. Any other questions? Once again, you got like the keywords here are find someone to buy it. Do you know where to go look for such people? No. And do you think your dealer is in the business of that sort of thing? Nope. Hey, if I'm going to do that kind of work for you, you know what I'm going to expect in return? Right? And so now you're selling at a discount. Okay, that's bonds. Now we're on to stocks. So remember, our formula or our definition of the price or value of anything is the present value of all the future cash flows discounted at a rate appropriate to the risk. Well, what are the future cash flows of stock? Well, they may pay a dividend. By the way, we're going to learn they're not required to pay a dividend, but they may pay a dividend. And then there's the money we receive when we sell the stock. And if I take the present value of all those expected future dividends and the value of the stock, present value of that future value of the stock, and add those all together, that's what the stock should be trading at today. That's what the stock should be trading at today. So let's start and develop our model. By the way, I'm going to teach you a couple of different stock valuation models. Should you use these models to go out and find stocks that you think are undervalued? No. Undoubtedly, other people have better information than you do about what these expected future dividends are. And so that's why your valuation of the stock does not match up with what's going on in the market. I'm not teaching you this stuff to go out so you guys can find undervalued stocks and buy them. I'm teaching you this stuff because I want you to understand what it is that drives stock prices up and down. And we'll talk about the different factors that go into that. So let's start off. We have a, yes?
Like some people have a better information than we do. Like, why do they have that more latest information? Because they have like insights.
Okay, so there is inside information and it's illegal to trade on. But even that, let's say that right now there's someone exactly your age sitting in an office in Wall Street and they're sitting there at a Bloomberg terminal. Do they have better information than you do at this very moment? Yeah. And so let's assume though that you're sitting at the Bloomberg terminal. Now you have the same access to information they do, except for one thing. Do you think that they go out drinking with their friends at night? Do you think they get to hear all the other opinions of the other people on Wall Street? Yeah, they're in that environment. And so we have this thing called the mosaic theory. And that is if I pick up these little bits and pieces here and there, and I can put them together and come up with a picture, then maybe it makes sense for me to think that I can spot an undervalued stock. Do you have that sort of network? No. No. And would you trade stocks in Russia?
I will try to. I want to try to.
Oh. Please call me when you're poor and I'll tell you about ramen noodles. Okay. Back to the story. I got a stock. I'm going to hold the stock for 1 year. And during that time, I'm going to collect one dividend at the end of the time, and I'm going to sell the stock for P1. Now, I don't know for sure dividend at time one, but it's relatively easier for me to figure out what that dividend is because dividends at firms tend to be sticky. My best guess for what the next dividend is the last dividend, right? So I've got a pretty good guess for that one. Now, what about P sub 1? Can anybody here tell me what any given share of stock is going to be worth 1 year from today? If you can, please come to my office. We will get rich together. Right? I've been making the offer for 20 years now. Still have not had a single taker. So you say, wait a minute, we'll never be able to figure out what P1 is. You're right. But I have good news. Because P1, we can actually calculate it. Because P1 is just D2 divided by 1 plus R. That's the present value of D2 brought back to time 1. And then P2 brought back to time 1. Whew! Problem solved. Except for one thing. What do we have to know now? P2! By the way, when is the weather forecast more accurate? Today or the day after? Yeah, so the closer in time you are, the more accurate your forecast. So my guess for P1 is likely more accurate than my guess for P2. And so now you're starting to say, well, wait a minute, I'm just going to give up hope. And I say, don't do that. And here's what we're going to do. We are going to say, well, wait a minute. What if we just keep pushing out that P till the very end? And so that last term is just going to be P, you guys know what that symbol is? Infinity. Divide by 1 plus R to the infinity. Now, infinity is a big flipping number. As long as R is positive, this is going to be huge. And so this equals going to be infinity. What is anything divided by infinity? 0. So this thing's basically going to go to 0. And so that allows us to say that the stock's value is just the present value of all the expected future dividends going out till the end of time. That's all we're saying here. So do we have to worry about what the stock price is going to be? No. We only have to worry about trying to figure out what these expected dividends are. By the way, we say expected dividends. Why? Are they known with certainty? No, this is just a swag, right? It's a scientific wild-ass guess of what these dividends are going to be. So we have 3 different kinds of models that we're going to use to value stock. The first is the zero dividend growth model. If the dividend has 0 growth, that means the dividend is the same over and over and over again. So that's what 0 growth means. Zero dividend growth is also known as constant dividends. So that first one is also known as constant dividends. The second model is constant dividend growth. The dividends grow at a constant rate through all time. The dividends grow at a constant rate through all time. So that's constant dividend growth. And then the third model, which is the most difficult, is differential dividend growth or supernormal dividend growth. And I'll tell you more what that means when we get to it. Now, some of you are saying right now, wait a minute, some stocks have 0 dividends, yet they still have positive stock prices. How can that be? Any ideas? It can, but why? And eventually they're going to have to do something. Oh, you're getting so close. Okay, I'm starting to lose hope here. No, they don't have to report what their dividend would be, but do we expect them to start paying dividends at some point? Yeah, okay, I don't think anyone earned a coin on that one. Okay, so here's the trick. And I'll run you through a real example. When Apple starts out, and let's go with any company. When any company starts out, are they just sitting on piles of money? No. And so what they have to do is basically reinvest every single thing that they earn back into the firm. Does that make sense? At that point, do they have any money for dividends? No. At some point, though, the money coming in starts to outweigh their needs for investment for every positive NPV project that they've got. So we've got $100 million worth of positive NPV projects. We've got $120 million coming in. What can we do? Pay $20 million in dividends. And so what we expect is as a company becomes more successful and becomes mature, it will start paying dividends. Does that make sense? So our stock price today is that present value of the expected dividends, even though those dividends don't start today, they start out at some point in the future. Does that make sense? If you look at, in fact, Apple, for the longest time, did not pay dividends. And then they started paying dividends, and now they've been bumping those dividends up. Lots of companies you see fit this model. Questions? Okay, so he's asking, should companies invest their own money into other companies? And the answer is this: only if it's a positive NPV project. This is what Chapter 21 is all about. When we go out to buy another company, we need to make darn good and sure it's going to be a positive NPV project, because if it's not, we shouldn't do it. Example, the buying of Netflix, or is it Netflix trying? Warner Brothers. And as soon as the word comes through that Paramount wasn't going to get them, or that Netflix wasn't going to, yeah, Netflix wasn't going to get them, what happens to Netflix's stock? It actually goes up. Paramount stock goes down. What does that mean? That's a negative NPV project. Should those people be pursuing that? No. Now, here's the next thing. Managers think they're so darn smart, which is how we end up with problems like this. As a smart manager, you realize you're not smarter than the entire market, right? You know that there are people out there with better information than you. And so instead of you going out and buying some lemon piece of crap company, what you're going to do is you're going to either repurchase the share of your own stock, or you're going to pay dividends. And you're going to put that money back in the hands of your shareholders, because after all, whose money is it? It's the shareholders' money. Put it back in their hands and let them decide where to invest it. It's the same thing when you hear companies talking about their charitable giving. Is it the company that's giving the money? No, it's the shareholders' money, right? Hey, maybe I don't want to fund whatever this crazy thing is that you're into. Maybe I think that genetically modified foods are good for kids, right? Why don't you send me the money and I will do the charity on my own behalf? Managers constantly forget whose money it is. Questions? Zero dividend growth, also known as constant dividends, and we actually have a stock that we model for using this. It's called preferred stock. I think I told you earlier about preferred stock. It gets paid before the common shareholders. Preferred stock has this dividend that's supposed to be paid every quarter, and it's fixed, and it happens over and over and over again. And stock is a lot like some people I went to high school with. It never matures. It never matures. So it's out there until the end of time, or till the company goes belly up, right? It's out there for forever, or until it's bought back. And so basically it just looks like a perpetuity. And if you remember, the value for a perpetuity was present value is equal to the identical cash flow divided by that rate. If I've got quarterly dividends, then that R is going to be in quarterly terms. If I've got annual dividends, then that little r is going to be in annual terms. As long as they match, I'm perfectly fine. P sub 0, of course, is today's stock price. So we'll do an example on that one. But let's talk about constant dividend growth. Now this is zero dividend growth, or constant dividends. It's where it stays the same through all time. Constant dividend growth means that it grows at the same amount every period. Turns out we actually have a formula to do this one too. We have that growing perpetuity formula. And we're just going to substitute D where we see C, and we're going to substitute P sub 0 where we see present value in that growing perpetuity formula, and it gives us this thing right here. Now I want you to notice that the D here has to have a little number 1 after it. Do you know why that is? Previously, we just had the D, and that D was the same in every period. But now we're having to say D1. Why? Yeah, so because the dividend is changing, right? There's only one of them that's going to have this value of D1. So he's absolutely right. It's the dividend that's going to happen at the end of the year. And in fact, if I had D3, I could figure out P2 using this formula. P2 is equal to D3 divided by R minus G. It always just has to be one period behind. Second thing I want you to notice is we've got a new letter in there. What's the new letter? G. What do you think G stands for? Yeah, it's the growth rate of the dividends. It's the growth rate of the dividends. And then we've got this little thing over on the right-hand side, R greater than G. Why must R be greater than G? Just mathematically, why must R be greater than G? Yeah, okay, so assume that G was greater than R. Then that thing on the bottom would be negative, and that would make the stock price negative. Is there such a thing as negative stock price? No, why not? It goes to zero because of limited liability. It can't go below zero, right? So limited liability is the reason that that can't happen. Now, what if R were equal to G? What would that bottom term be? Zero. What happens when I divide by zero? Oh, I'm going to ask an engineer. You're a chemical engineer? What is anything divided by zero in the engineering world? Okay, so that's what the mathematician would say, is it's undefined, undefined. Engineers, we tend to think of it as being infinity. Either way, not going to work for us, right? So R must be greater than G if we have this long-term constant growth. Now, what we're going to see when we get into supernormal dividend growth is that for short periods of time, we can have G greater than R. But we can't have it for this constant dividend growth situation. I want you to notice something else here. D1 is equal to D0 times 1 plus G. So D0 is the dividend at time 0, D1 is the dividend at time 1, and you need to learn how to know one from the other. And so you've got to read. Last dividend was just paid. Those most recent. Those are all D0. If you see D1, its next dividend will be, or dividend at end of year. And so basically what we do is we look at these and we say, is it past or present? If it is, then most likely we've been given D0. If it's future, then it's most likely D1. Now, why do I say most likely? I'll tell you a problem from the exam right now. Are you ready? This firm plans to pay a first dividend at time 3. Would that be D1? It's in the future. No, what would it be? D3, right? It would be D3. And how would I figure the price? Well, I would say P2 is equal to D3 divided by R minus G. And then I would take that P2 back 2 periods in time using my financial calculator. And that's going to give me the share price today. So you need to read and figure out which one of these you've been given. And if you're given D0, you can substitute D0 times 1 plus G anywhere you see D1, and you're good to go. Any questions? Okay, we will work through the remainder of the calculation stuff on stocks on Tuesday, and try to get into stock features.